In the recent 2025 budget, the government dropped a bombshell announcing one of the biggest shakeups to pension taxation we've seen in a generation. So today, we're going to break down exactly what these new inheritance tax reforms mean for your pension, for your family, and for your financial future. So let's cut right to the chase. Could your pension pot really face a 40% tax hit? Well, the short and, frankly, quite shocking answer is yes, it absolutely could. For decades, you see, pensions have been a kind of safe harbor, a really tax-efficient way to pass on your wealth. But the government has just completely rewritten the rulebook, and this one change could fundamentally upend your entire estate plan. Now, trying to navigate these changes can feel a bit like walking through a maze in the dark. That's precisely why we've teamed up with the experts at My Tax Accountant. They've helped us break down this incredibly complex topic to give you the clearest possible picture of what is happening, and most importantly, what you can actually do about it.
To understand why this is happening, you really have to look at the government's thinking. And this quote, taken directly from the budget documents, tells you everything you need to know. The stated goal here is to create what they are calling a fairer contribution from wealth. And well, your pension is now squarely in their sights.
Okay, so here's our game plan for today. First, we'll look at the big picture from the budget. Then, we'll put the old rules side by side with the massive new changes. We are definitely going to spend some time on a really critical detail called the double taxation trap. You'll want to pay attention to that. And then we'll get to the most important bit, a clear action plan and how to get the right help.
Right, Section 1, the big picture. Look, this pension reform isn't happening in a vacuum. The 2025 budget has laid out a really broad strategy to raise more money from various sources of wealth, not just from the income you get from your job. It's a response to all sorts of economic pressures and a clear desire to see asset growth contribute more to the public purse. This includes changes to property taxes, dividends, and now, pensions. It's all part of this wider push to increase the tax take from assets that have, until now, been very lightly touched. On to Section 2, the old rules. To really get your head around just how huge this change is, we have to understand the system we're leaving behind. For a very long time, pensions held this special, really privileged position when it came to tax. And that was done on purpose, to encourage all of us to save for the long term. And this slide just illustrates the old system perfectly. While most of your other assets, your home, your savings, your investments, were all lumped into your estate and potentially on the hook for a 40% inheritance tax, or IHT, well, most pensions just weren't. They sat completely outside of the IHT calculation. This made them an incredibly powerful tool, maybe the best tool, for passing wealth down to the next generation completely free from inheritance tax. That was the absolute key benefit. Which brings us to Section 3, the big change. Because as the November 2025 budget made crystal clear, that privileged position is coming to an end. Honestly, this was one of the most significant changes to pension taxation in decades, and it fundamentally alters the landscape of estate planning for millions of people all across the UK. So let's quickly look at the timeline here. The announcement was made in November 2025. Right now, as we speak, we are in a crucial planning window. The rules have been clarified, and this is the time to act. But the key date you need to circle on your calendar, maybe in big red ink, is April 6th, 2027. From that day forward, the new rules kick in, and any funds left in your defined contribution pension pot will be included in your estate for IHT purposes. And this is the number that really matters now. 40%. The standard rate for inheritance tax, a tax that, for the most part, pensions have been completely sheltered from for over 30 years. This is the rate that could now be sliced right off the top of the wealth you've so diligently built up in your pension. And just as a quick refresher, inheritance tax, or IHT, is a tax on the value of your entire estate when you die. Currently, everyone gets a tax-free allowance, which is called the nil rate band, of £325,000. Anything above that threshold is typically taxed at that hefty 40% rate we just saw. And, did you know, there's also an extra allowance if you pass on your main home to your kids or grandkids. But the key takeaway here is that your pension is now going to be part of that main calculation. Okay, now for Section 4, and please stay with me here because this is a detail where so many people are going to get caught out. It is by far the most dangerous part of these new rules. We're calling it the double taxation trap. So here's the problem. While the government has changed the IHT rules for pensions, they have not changed a completely separate set of rules around income tax on inherited pensions. As you can see, if you pass away before you're 75, your beneficiaries can usually take out the pension money tax-free. But, and this is the big one, If you die after 75, your beneficiaries have to pay income tax on it at their own rate. It's the collision of the new IHT rule and this old, unchanged income tax rule that creates this devastating trap.
Let's look at the trap in action, because the numbers are just jaw-dropping. We've got a £500,000 pension pot here, and let's assume the owner dies after age 75 and their IHT allowance is already used up. Right now, under the current rules, there's zero IHT. Your beneficiary, let's say they're a basic rate taxpayer, pays £100,000 in income tax as they draw the money out. They walk away with £400,000. Pretty good. Now, look at the new rules. The tax hits twice. First, that 40% IHT charge, a whopping £200,000, comes right off the top. Then, your beneficiary pays 20% income tax on what's left. The final amount they actually receive plummets to just £240,000. Just look at those two final numbers side by side. It is a massive, massive difference.
Let's make this real for a second. Imagine Aisha. She's a 55-year-old freelance designer in London. She's worked hard her entire life to build up a decent pension of £500,000. She's not just counting on it for her retirement, she's hoping it will be a legacy for her 2 kids. That $160,000 difference we just saw on the screen, that's not just a number in a spreadsheet. For her kids, that could be the difference between being able to afford a deposit on a flat or not. It could be the seed money for a new business. This single rule change could dramatically alter their future.
So let's put one final, brutal number on this problem. When you combine the 40% inheritance tax with the 20% income tax that's paid on what's left, the total effective tax rate on that inherited pension becomes a staggering 52%. I'll say that again, 52%. For basic rate taxpayers, the total tax paid has effectively increased by 160% compared to the current system. And if you're a higher rate taxpayer, well, the situation is even worse.
Okay, that's the challenge, and it is serious. But it is not hopeless. The good news is you have this planning window between now and April 2027. So in Section 5, let's talk about your action plan. Let's talk about what you can do.
Here are 4 really clear steps you can take, starting today. First, assess your entire estate. You can't make a plan if you don't know your starting point, and that starting point now must include your pension funds. Second, dig out your paperwork. Specifically, you're looking for something called an expression of wishes form. Third, start exploring the options available to you, because there are still strategies to soften this tax blow. And fourth, and this one is absolutely vital, seek professional advice to make sure your plan is robust and actually right for you and your family.
And here's a little pro tip for you focusing on step 2, that expression of wishes form. It's an often overlooked bit of paper, but it has just become one of the most important documents in your estate plan. It's how you tell your pension provider who you'd like to receive your funds. Crucially, keeping it up to date can give your beneficiaries much more flexibility and more options, potentially helping them avoid taking a huge taxable lump sum all at once. An out-of-date form, maybe one that still names an ex-partner, could cause enormous legal and financial headaches down the line.
And that brings us to our final section, getting expert help. Look, the way inheritance tax and income tax now interact with pensions is incredibly complex. And the stakes, as we've just seen, are very, very high. Making the right choices for your family really requires specialist knowledge. And of course, we have to state this clearly. The information in this presentation is for general purposes only. It should not be relied upon exclusively to make your financial decisions. Before you make any decision, you absolutely must consult a professional. If you need tailored advice that's specific to your circumstances, whether that's on inheritance tax, estate planning, or any other tax issues, the experts at My Tax Accountant are available to help. You can reach them on 0208-570-8531, or you can email them at info@mytaxaccountant.co.uk. So we'll leave you with this one question to think about. The rules have changed, and the clock is ticking towards April 2027. Are you, and is your estate plan prepared? Thanks for joining us.